Welcome. In today's video, we're diving into variance analysis. It's one of the most useful tools in managerial accounting for controlling both costs and improving performance. Variance analysis involves comparing a company's actual results to its budgeted or standard results to see where things went differently than planned. By identifying these differences, which are called variances, managers can determine whether costs were higher or lower than expected, and then identify potential areas of concern. This leads us to the concept of management by exception. Rather than investigating every single result, managers focus their attention on specific areas where significant variances occurred. This lets them spend their time where it matters most, on the exceptions that could significantly impact profitability or efficiency. In this video, we'll explore how to calculate and interpret variances and how management uses this information to make informed strategic decisions. Now let's get started. In this first one, we're going to learn the basics of calculating a variance. As well, we're also going to talk about how to use a little bit more complicated Excel formulas like the if statement. The important part of this one is that each one of these questions is going to be a discrete problem. That means that they don't play on each other. We're going to look at each one individually. Additionally, variances should not have a negative number. So we're going to introduce the concept of the absolute value formula. We start our formula and type ABS. This lets Excel know that we want an absolute value. In this case, we're going to take our actual cost minus our standard cost. And we're going to come up with 15 cents. Now, if we didn't put in the absolute value formula, I'm just going to go ahead and take out the ABS on us. We would see this would come out as negative, and that's not what we want. So we'll go ahead and put that back in, ABS. Next, this one gets a little bit more fun. We're going to introduce an if statement. And this is going to be a conditional result where, depending on what our answer came up with here in the variance, it's going to let us know, is this going to be a favorable variance or an unfavorable variance? Now we're going to jump into the if statement. So we'll do equals and then if, which is the formula, and open parentheses. This is telling us that the first step is a logic test. Then we have a value if the logic test is true, that's our output, and a value if our logic test is false, that would be our second output. So in ours, we're going to go ahead and do another parentheses because I want to start with my first formula, which is actual costs minus my standard costs. I'm going to close that, and I want to see if that is going to be greater than 0. We're going to put our comma here, and that allows us to move on to if this is true. I'm putting in a quotation mark because I want my output to be words, and I want my words in this case to be unfavorable. And then do a comma, do our next one, the other one will be favorable. Close our parentheses, and here we go. Favorable. Now let's go ahead and double check to see if this makes sense. In this one, my actual costs, which represent how much I paid for my materials, I paid $12.15. My standard cost, which, as we talked about earlier, is the budgeted cost, says that we were expecting to spend $12.30 per ounce of material. So in any other time, if I asked you if you spent $12.15, is that favorable or unfavorable to a budgeted $12.30? That is favorable. You have 15 extra cents than you anticipated. The rest of these now are going to move pretty quickly. They're working the same way we did before, where we're going to take our actual cost minus our standard cost. But we don't want to do that without our absolute value formula to make sure that our result is going to be a positive number. And then in here, we'll do our if statement, our logic test again, making sure first that we are doing our math, making sure that that is going to be greater than 0, comma, unfavorable, comma, or favorable. Close my parentheses. All right, I'm not going to run through the rest of these because they go through the exact same thing. We're going to go ahead now and move on to the next step. Use what we just learned in variances, and extrapolate that out to be able to calculate direct material variances and also direct labor variances. These are two different flavors of kind of the same process. Remember, we're using management by exception, so we're trying to see if there's any areas that specifically stand out and that we should focus our managerial time on. We are going to be starting with direct materials variance. And inside of a direct material variance, when we calculate it, it helps us break the variances into two different components: a price variance and a quantity variance. The price variance is going to help us determine what was the change due to prices and how much they varied from what we anticipated in our budget. And then our quantity variance, which is when we originally put together our process, we estimated we'd need a certain amount of material to complete it. Are we above or below that amount of material? And then overall, how did that affect our total direct materials on our production? So let's start. This works first with taking our actual costs. So we are going to take our actual quantity and multiply that by our actual cost. And I'm going to let Excel use this for me. So in the way this chart is set up, all the standard costs are at the top, all the actual costs are at the bottom. We've got two different things going on here: a direct materials variance, which I'm going to make yellow. It's going to make our life a little bit easier. And then direct labor variance, which let's go ahead and make this something like orange. Now I'll go in and break these apart. So here we go. Direct materials, standard amounts here. Both of these are for direct materials. These will be yellow for us. These items down here are also direct materials, so we're going to use those as well. These down here are direct labor. Again, this is just a visual process for me, so I can go ahead and easily identify where these different costs are going. All right, so I know I need to take my actual quantity multiplied by my actual cost. So down here, my actual quantity of materials used in pounds is this 32,118, multiplied by my actual cost, the $14.21. Now the next one, we're going to take our actual at standard. So we're going to take our actual quantity multiplied by the standard price. And then for us, our actual quantity is this here, our $32,118, multiplied by our standard price is the $13.48. So we're getting this $432,950.64. When we move on to the standard cost, this one's not going to surprise us. We should be taking our standard quantity multiplied by our standard price. Standard quantity that we are going to need. This one tells us it's going to be 2.2 pounds. If I just multiply 2.2 pounds by the $13.48, that's clearly not going to be right. So this is where we have to take into account the actual units produced, the 13,836. And this formula, what we will first do is we're going to take our standard quantity per unit and multiply this by the amount of units produced. And then we will take that and multiply it by our standard cost per direct material unit. We get up $410,320.42. This starts our process for us. So now I said earlier, we're going to go in and focus on the price variance, where I am going to take absolute value formula here, and I am going to take my actual cost, and I will subtract out my standard, my actual at standard. We get a variance of $23,446.14. And we're going to do just what we did before. We'll do our if statement, and we'll take our actual at actual minus our actual at standard, close our parentheses. Is that going to be greater than 0? If so, it will be unfavorable. And if not, it will be favorable. We'll just go ahead and check that with our own logic. So if our actual costs are $456,396, and what we expect expected them to be at this level was 432,950, that is going to be unfavorable to us. We ended up spending more than we budgeted. Now we're going to move over into quantity variance. This is essentially measuring how efficiently are we running our operations. Are we using too much materials, or did we come up with some sort of increased efficiency? Maybe we implemented a new machine or some sort of new process for our employees. The math part works the same. We'll take our actual at standard and subtract from it our standard at standards. And then we'll move into our if statement. Double parentheses, we'll do our math. In our logic statement, is that going to be greater than 0? Greater than 0. If not, we're going to take unfavorable. And if so, it'll be favorable. When we do our logic test on this one, it may seem counterintuitive. We see our actual at standard is more than our standard at standard, and we might think, well, that's favorable. But we need to focus on what we're looking at. We're looking at the quantity variance, and that's measuring how much material did we use based on how much did we think that we would need. So let's go ahead and draw it out for ourselves. So our budgeted amount here is the amount of units produced multiplied by the standard material used, 2.2 pounds. And then our actual material that we used is 32,118 pounds. When we draw it out this way, we can see that we only thought we would need 30,000 pounds of material, but in fact, we used a total of 32,000 pounds. That is going to become unfavorable for us because that additional material has an additional cost. And lastly, we are going to be taking our direct materials variance. Now this chart does show that it's going to be the combination of both the quantity variance and the price variance. But to do the math on this, we're going to take the absolute value. We're going to take our actual at actual and subtract the standard at standard. That gives us 46,076 and 36 cents. We're going to use our same if statement that we would normally do, equals if, parentheses, parentheses, where we will take our actual at actual minus our actual at standard. Check to see if that is greater than 0. If so, it will be unfavorable. And if not, it will be favorable. And it is unfavorable. So again, we'll just use our own personal logic test. We actually spent $456,396. We only estimated that we would need to spend $410,320. This one, even if using management by exception, we would have to investigate why did the price go up so much, and additionally, why did the materials go up so much? As in, like, why did the amount of materials used go up so much? The process moving on to direct labor variances is going to work the same way. So we're going to run through it pretty quick on this one. It's still going to be actual quantity at actual cost, actual quantity at standard price, and then standard quantity at standard price down here for direct labor, but we're focusing specifically on the labor amount. So we'll look at our chart above, and we know that orange is going to be for our direct labor. And I'm going to take my actual cost, which is going to be the $21.57, and multiply that by my actual hours used. We get our 468,000 and change. My actual at standard, so we did use 21,734 hours, multiplied by our standard direct labor hour rate is $22.13, so we get $480,000 and change. And then our standard at standard, same thing we did before. We're going to need a little bit of a formula here because we know how many units that were produced multiplied by our standard hours per unit, which is 1.65, then multiplied by our standard price, the $22.13. We get $505,214. We're going to do the math for these again using our absolute value. We're going to take our actual at actual, subtract out our actual at standard. And then for this one, I'm just going to go ahead and drop this formula in, and it's coming out as favorable. So let's check ourselves on this one to make sure it makes sense. $468,000 was our actual cost. We estimated it would be $480,000. So our actual costs were less than our standard costs. That is a favorable variance to us. Now again, when we are working with labor, we're not going to be talking about quantity variance. It's specifically going to be called efficiency variance. And the same thing when we're looking at the dollar difference, it's not going to be called a price variance. It's called a rate variance. To calculate that efficiency variance, we're again going to use that absolute value formula, take our actual at standard and subtract out our standard at standard. We end up with the $24,241. I'm going to go ahead and just drop the formula in here, and it's coming back as favorable. So let's just double check it for ourselves again, and we'll do our logic check on this one, focusing on hours. So our budget is going to be our units produced multiplied by the hours per unit, and then our actual amount of hours used are going to be the 21,734. So we see that we are using less hours. We've experienced some sort of efficiency, which would create a favorable variance for us. We'll move down to the last part, again, where we're going to take our actual at actual. We'll do the absolute value of our actual at actual and subtract from that our standard at standard. And then I'll add the formula in this one, and it is again favorable. This one should kind of work out that way when we see that we have a favorable variance here and a favorable variance here. Our total variance is also going to be favorable. Now we're going to go ahead and look at the total operational effect on this, both from direct materials and direct labor. We see that we had an unfavorable variance up here from our materials and a favorable variance here in our direct labor. When we see those two items, we are going to subtract them from each other. We'll take our 46,000, subtract out the 36,000. That is going to give us a total variance of 9,664. And then once again, we'll use that if formula, doing the same thing. And I'll just pop that in. It gave us unfavorable. You can now understand how to go ahead and create variance analyses and make decisions from them. On to the cash collections budget. This is an important part of the budget that helps a business plan when they'll actually receive cash from sales. As we know, in accounting, we use the accrual basis of accounting, which means revenue is recognized when earned, but not when cash is received. So while sales budgets show how much a company expects to sell, the cash collections budget focuses on timing, when those sales turn into real cash inflows. We'll walk through how to prepare a cash collection schedule for credit sales on account. So let's jump right in. This one's broken into two different components. These are the amount of our sales on account, and this is our collection schedule. So this is not recognizing any cash sales, which means someone gave us cash immediately. These are only sales on account, which means someone is going to pay us in the future. And this is how much we're expecting collect in each of those months. So in the month that we make the sale, we're going to collect 83% of our accounts receivable. The next month, 12%, and the second month after that, 5%. This is very common in business. Most people do pay on time. A smaller amount goes ahead and pays after the due date, and hopefully an even smaller amount pays after that. So when building this one, we're going to start with building what are our total amount of sales in each one of those months. So January is the 1.9 million, February is the 2.1 million, and March is going to be the 2.4 million. This chart really has two separate components. The part on the side here, we're reconciling the cash received to the sales that month. And then this over here is helping us calculate the amount of sales that are going to be turned into cash in each one of those months. So this over here, the cash collected in January, is all going to come back to that 1.9 million because that is the total sales on account in January. And our collection percentages are coming from our chart up here. So in January, we're expecting to collect 83%. In the next month of January sales, which would be in February, we're expecting to collect 12%. And then for January sales, we should collect 5% in March. So when I carry these across, I'm going to see that of the $1,956,000 in sales in January, we're actually going to collect that multiplied by the 83%, $1.6 million in January. Now, in February, we're going to still be collecting some of our January sales. 12% of what our gross sales amount is going to be. At least our gross sales on account. So that's $234,000. And then in February, we're expecting to sell another $2.1 million in product on account, with the same month of sale collection being 83% and the next month being 12%. So in February, we're going to collect $234,000 in sales from January, and we're going to collect an additional amount of the February sales of $1.797 million. That's going to give us total cash collections in February of $2,032,000. In March, we are still collecting part of our January sales. That's only 5% of them. So we take our $1.9 million multiplied by that 5%. We get $97,000 in sales from January being collected in March. And then as well, March is going to have 12% of the $2.1 million, or another $259,000. And then in March, we are also selling $2.4 million. And in March, we are expecting to collect 83% of that. So the 2.4 multiplied by the 83%, we end up with $2,064,000 in sales. We'll add all three of those: the last collection from January, the second collection from February, and the first collection from March. That gives us $2,421,000 in cash collections. This is a really good problem that explains to us when we're in business and when we're selling items on account, there is a delay from when we send the invoice, when we recognize revenue, and when we finally have cash to pay for things like supplies and our employees. We should always be conducting a cash collection schedule to make sure we're able to meet our demands. All right, I hope you all found this video really helpful, and we will see you on the next one.